All right, we're getting started on time, hopefully. So welcome everyone to the session on new measures. I'd like to introduce our speakers, Buhui, who's joining us from the University of Sydney, Sehoon at the end, who's from Florida, the University of Florida. And then I also wanted to thank our discussants more than the presenters for Aaron Yoon, who's joining us from Northwestern University, Athanasia Karananou, who's joining us from RBC Brewin, Dolphin, so from the UK. Our format is 15 minutes for the presenters, 12 for the discussants, and then we'll open up for Q&A. The purpose of the session is, as you see here, it's called New Measures, and the purpose is to talk about, data and processing of the massive volumes of alternative data that we now have, and textual data within the ESG context to inform decisions. As you'll see, there will be a lot of data processing, but the goal here is just can we get to a better destination with all this? There's more than just textual data out there. There's sensorial data, satellite imagery, and so forth. And the purpose of this is to highlight two academic studies, but also make a call for collaboration between the audience and the academia. If you're aware of new research, new data, new empirical designs, please, feel free to jump in. So we have this order, but I will assure you we got to you guys as well towards the end of the plan. So without further ado, I'd like to introduce our first presenter, Buhui, who will be talking to us about greenwashing. The floor is yours.
Thank you so much, Pedro, and the organizer for having our paper on the program. Really appreciate. And really thank you for Aaron and Athanasia for discussing this paper. They spent a lot of effort and time, really appreciate. And also thank you everyone for attending the session. So my paper is about greenwashing. Measurement implications is with a team of researchers from University of Sydney and also some New Zealand researchers. So basically, a recent Wall Street Journal article basically claims that nearly 3/4 of corporate leaders say most organizations in their industry would be caught greenwashing if they were thoroughly investigated. So greenwashing obviously is not a new concept. It's actually, this concept has been there since 1980s, right? So, but it actually captures a lot of attention, especially after the Paris Agreement in 2015. For example, the Earth.com.org in 2022 claims that greenwashing can be as subtle as a misleading packaging choice, all the way to fossil fuel companies touting themselves as being eco-champions. So either way, greenwashing is harmful and a deceitful way of advertising that the company is more sustainable than it actually is. So companies that make false claims should be held accountable. So what exactly is greenwashing? As you know, greenwashing basically from Earth.org, basically they claim that greenwashing is misleading public communication about the firm's actual green status, right? So propaganda disseminated by organizations so as to present themselves as being environmental friendly, while actually it's not. This is from Oxford English Dictionary. So in research, actually, there are some papers looking at greenwashing. For example, this Delmas and Babano paper in California Management Review, they basically define greenwashing as basically the distance between green talk and the firm's actual green walk. So it's, basically what they say is greenwashing are those with poor actual environmental performance firms communicating positively about their firm's environmental effort. And there are two recent papers by Walker and Wang and Pazzetti et al. Also define greenwashing similarly as being the distance between green talk and actual green walk of an organization. So those papers that I just discussed, they usually either only talk about the framework of greenwashing and incentives of greenwashing, or they basically measure greenwashing using very small sample. For example, the Walker and Wang paper basically look at only 1 year of about several hundred firms. Actually, they look at the ESG disclosures of those firms manually and then check the disclosure, the truthfulness of disclosure with the firm's reality. So only 1 year of data, some less than 1,000 data points. But we need some large-scale data to really be able to detect greenwashing, right? So this is what we're going to do in this paper. So I want to be very clear what we are doing. We want to detect greenwashing, but the greenwashing we want to detect is not the product-level greenwashing, right? Product-level greenwashing is, for example, a firm misrepresent their products' environmental benefits, right? So, for example, a fridge, they will say this is a 5-star fridge in terms of green rating, but actually it's not. Those are not what we want to look at. And also, there are papers by Pedro, by Aaron, looking at institutional investors greenwashing, right? So, for example, Pedro's ROF paper looking at how institutional investors globally, when they sign up with PRI, whether they basically, their signatories signal the investment quality of the companies, underlying portfolio companies or not. And what they find is basically that, especially for US institutional investors, the signatories institutional investors' portfolios, their ESG rating is not actually better than the non-signatory companies. And Aaron's paper, the management science paper, also look at mutual fund investors and find similar conclusion. So these are institutional investor greenwashing. And what we are looking at in this paper is basically corporate greenwashing. Basically, what we want to see, what we suggest is that a firm's green talk is actually not necessarily be equivalent to its green walk, actual green walk. And we want to construct a firm-level greenwashing measure that captures this distance between green talk and green walk using machine learning. So how to identify green talk? We rely on the firm's earnings conference calls, right? So why? Earnings conference call is a routine venue for managers, corporate managers, to communicate their firm's fundamentals and outlooks, business outlooks to investors every quarter, right? Usually it's after they release their quarterly financial result. And it's a routine venue, and basically it involves direct communication or conversation between the manager and the analyst. So basically this is a forum where managers can portray their firm's green image. It's a more flexible venue than 10K filings of the firm, right? 10K filing is more, it's not more subject to regulation. You have specific structure and specific framework. But conference call transcripts are basically a more flexible venue. So we expect that if there is the firm going to do greenwashing, it's more likely to do this through the conference call venue. So the green talk we capture basically is the firm's climate discussion that the corporate executives self-tout their firm's positive environmental investment effort and performance. So those talk is not general talk, but firm-specific and enthusiastic self-touting of their firm's environmental performance effort and investment. So because we have more than 100,000, actually it's 107K earnings conference call transcript to process. So we use a machine learning model rather than we read each conference call ourselves. So we employ a Finberg machine learning model to help us identify green talk sentences where the manager is self-touting their firm's environmental performance. So what is Finberg? Finberg is actually a variant of the BERT, right? The Google's deep learning large language model, right? So different from BERT, Finberg is trained on financial data. The BERT model is trained on Wikipedia and Google Books corpus data, but the Finberg is trained using earnings conference calls, analyst reports, and 10K thank you data. So it's better able to, and research show that Finberg will be able to predict sentiment, especially ESG sentiment of firms. So it's really good to use it to detect green talk in our setting. So our machine learning model, we have all the details, how we train the model, but I just want to tell you that our model achieved an accuracy of 90% in using the training data set. So for example, the green talk sentence that we identified something like, we're excited about the progress that we have been making, our firm has been making to combat climate change and enable a cleaner, more sustainable world. This is very positive, enthusiastic about the firm's environmental effort. So the non-green talk or general green talk that we find, those are not really our focus. Is, for example, this one, the weaker wind resource was the primary driver of the negative $0.04 contribution from existing wind assets relative to the previous year's comparable data. So this is basically, this one is also climate related, but it's not actually green talk, right? So our model will be able to distinguish between these two types of talking to be able to really capture green talk. And then the green talk we construct using machine learning, but the green walk, we actually use rep risk to capture green walk. Rep risk is basically an event-based data set that captures all the negative events, risk events of a firm using 100,000 media sources in 23 languages on a daily basis. So we use rep risk because it has been shown that rep risk is usually third-party based, unbiased. It's not subject to self-disclosure. And if a firm is caught having an environmental incident, it's going to be recorded in rep risk. And rep risk is really good for record the actual green walk of the firm, right? If a firm has a lot of environmental incidents, then the firm's green walk is pretty bad. So we count the number of green walk environmental incidents in each firm year, and then rank the sample firm into percentiles each year based on the environmental incident count. And then we multiply the incident count by -1 so that a lower value means worse environmental performance. So our greenwashing measure is basically our machine learning-based green talk measure in percentile ranking minus the green walk rank, percentile rank, divided by 100. So it's basically ranging from 0 to 2. 0 being a firm with no green talk or a non-greenwashing firm. Anything above 0 is basically a greenwashing firm, but the closer to the 2, the more intensive greenwashing the firm is. And this is basically we aggregate our measure to the economy-wide level. What you can see is that there is a spike in greenwashing, especially after 2015 Paris Agreement. The bars basically tell you how many firms doing greenwashing. For example, in 2021, we have closed 500 firms that have greenwashing in our total sample of more than 4,000 US public firms. And our greenwashing measure, the average ranging from 0.1 to 0.25. So it's pretty a lot of variation, time series variation. In terms of industry variation, we find actually the utilities, this is the top 10 greenwashing industries. The utilities like coal and metals, mining, construction, those are high greenwashing industries. And then we run some DID regression. As you can see, we find actually firms in the fossil fuel industry actually experience a spike in greenwashing after 2015. And similarly, if we look at the broader stranded asset industries, which include fossil fuel and some other industries like metals and mining, etc., we find actually also similar spike after the 2015 Paris Agreement. And then we look at whether the greenwashing firms do anything to improve their environmental performance or not. What we find is that those firms actually have more environmental incidents in the future. They are more likely to be enforced by EPA, and they actually generate more carbon emissions in the future. But we do not find they show any green effort. We do not find any increase in green innovations of those firms. So in summary, those firms actually, they are really greenwashing. Their actual performance is bad, but they do not show effort to improve their environmental record. So, and then we look at how is greenwashing relate to the shareholder and stakeholder impact. What we find is that for greenwashing firms, actually the 5-day cumulative abnormal stock returns after earnings conference call is pretty negative. On average, if the greenwashing measure increased from 0 to 1, the cumulative stock return actually go down by about 30 to 40 basis points. And our greenwashing measure will also be able to predict future negative operational performance, like ROA and operating cash flow to total assets, very significantly. And then we find actually that greenwashing is bad for stakeholders and shareholders. Now, why is that firms want to do greenwashing? What we find is that greenwashing helps the firm improve their environmental ratings. We look at several types of ratings: Refinitiv, MSCI, KLD, and Sustainalytics. We all find an increase in those ratings after the firm greenwash. And we also find that greenwashing CEOs are less likely to be fired forcefully, and the sensitivity of forced CEO turnover to operating performance become lower after they greenwash. This indicates that there's a better executive job security after the greenwash. And we find that CEOs' compensation is less sensitive to corporate operating performance and more closely tied to environmental performance of the firm after the greenwash. And as a result of this compensation structure change, actually, those greenwashing firms reduce their risk-taking activities in the future. They spend less on R&D and less on acquisition. They enjoy quieter life. They hold more cash, and they lower their firm's financial leverage. So to summarize, basically, in this paper, we match corporate green talk identified by Finberg with actual environmental incidents from reg risk to construct a gap. The gap between green walk and green talk, we call it greenwashing. And this is, we apply this measure to a broad sample of US firms, more than 4,000 firms, over the last 15 years. And the developed measure enables efficient and large-scale tracking of corporate greenwashing intensity. We'll be able to aid investors in more accurate allocation of capital. And our finding points to an agency explanation of greenwashing. Managers engage in greenwashing to increase their job security, to increase their compensation, but at the expense of shareholders and other stakeholders. So investors incorporate this measure into their risk assessment to enhance the due diligence and safeguard their portfolios against long-term risk. And we think that regulators will be able to use this measure to gauge the effectiveness of environmental disclosure regulations in reducing economy-wide greenwashing. Thank you very much.
Oh, it's perfect. So you saw the first large-scale study, so I invite Sehoon Kim from Florida to show us why not go back 130 years and examine a modern form of ESG, CSR, and many other things. So we're going to take a look back with the second paper.
Wonderful. Well, thank you to the conference organizers for inviting me to present our work at this spectacular and important event. Let's see if I can actually, okay, there we go. Perfect, okay. So thanks again. This is co-work with my colleague Joel Houston and our PhD student Boyan Lee. I don't think there's much need for an introduction to this audience in particular to the fact that the world of investing in the recent decade or two has been taken by storm by ESG and sustainability, and a lot of us view this as a new phenomenon or a paradigm shift, right? A new way of thinking about investing that will change things forever and hopefully open new frontiers and things like that. Now, what I'm trying to say today is that, well, this view is problematic and perhaps we can do better. So why is this view problematic? Well, if you think about ESG as really a new thing, well, then by definition, there's only so much you can do in terms of evaluating, for example, long-term consequences, since by definition, the recent objects of ESG that we're interested in, we've only started measuring so recently, right? But why this is problematic? Well, some of the cornerstone arguments for caring about ESG in the first place are things like ESG is critical to creating long-term value. Now, how would we evaluate those claims if we were to only look at emissions data for the past 10 or 15 years, right? And indeed, a lot of studies in the literature are like this, right? Are mostly confined to recent time periods. Even if we were to look at papers that are related to corporate social responsibility that goes back a little bit longer than ESG. And perhaps even more important than that is that we really don't have a good understanding about which aspects of ESG, and we're all coming to grapple with the fact that ESG is uber multifaceted. We don't know which aspects of ESG become more pertinent issues to stakeholders at different points of time, why that is, and what are the consequences of these kinds of changes for firms, right? And these are all really important questions. And so our approach was to take a breath and step back a little bit, right? And take a longer, richer historical perspective and think about what's happened over time. So if we were to just look at the tiny corner of the world called the United States and look back at its history, going back to the late 19th century, for instance, Andrew Carnegie, toward the end of the Gilded Age, emphasized the importance of giving back to society by the ultra-rich. And then in the 1930s, we had political/academic debates about whether corporations should be held socially responsible. And then in the 70s, we have the famous Milton Friedman doctrine, which of course was in itself a commentary on corporate responsibility. And then only in the early 2000s have we even come to terms with ideas like ESG, right? So in other words, the emphasis on the fact that there are certain externalities that we might or might not want businesses to address is not really something brand new, right? It's been happening and in different guises and forms, but nonetheless repeatedly over the course of history. Okay, and so that's basically the premise of what we're trying to bring to the table here. So what we're trying to do is bring to the table this notion that perhaps with the advanced arsenals that we have at our disposal these days, maybe we can harness that rich historical information to tell us more, give us richer data for us to answer some of the most important questions related to ESG and social responsibility in a more deeper and convincing way, right? And so what we do is we apply textual analysis. Specifically, we train our own language models using a word embeddings approach to measure the extent of public interest or attention to environmental and social issues in the context of business and the economy throughout US history in the past 130 years by looking at Wall Street Journal and New York Times articles going back 130 years. Okay? So that's sort of just a demonstration of how one might go about using these tools to develop measures to answer some questions that are important to us. Then we can go about looking at this measure, how it's evolved over time, and perhaps answer some questions that we even really haven't thought about asking. For example, how is this measure related to macroeconomic or even socioeconomic factors? Okay? And this is going to be important, perhaps especially in this time and day when we're seeing a lot of shift in what we're talking about and the kind of pushback that we see from different corners of politics or society, right? And what can we learn then, right? We can use this for many different kind of applications that are relevant for finance. What can we learn, for example, about the real effects of these public concerns on companies and how markets reflect these kinds of effects, right? Okay, so to do this, the first big challenge is to somehow be able to account for the fact that the way we speak about ESG and the issues that we care about within ESG are changing over time, right? That's the first challenge. And to do that, so what we're going to do is for different time periods, we're going to train this rich text to develop our own time period specific language models that are going to be varying over time. This will enable us to capture the evolution and of semantics and context. Okay? And then what we're going to do is we're going to use those time-varying language models to span, for different time periods, an environmental and social dictionary that lists an expansive set of keywords that are most closely related to issues that we fundamentally think of as environmental and social externalities, like pollution, discrimination, and inequality. Now, the challenge here is that we need to be careful to not imbue our own bias from the researcher in terms of what ought to have been important issues in different points of time, coming from our own preconceptions about history, but sort of letting the methodology work itself out. And so to do that, we kind of discipline the approach by feeding our language models what we call universal seed words, right? And these are going to be words that show up in every time period and can be interpreted unambiguously as encapsulating these kinds of environmental or social issues. For instance, pollution, you can think about it in terms of climate change or air pollution, water pollution. In terms of discrimination or inequality, you can think about gender, race, economic inequality, and so forth, right? Which as discussions have changed over time. Now, once we have these time-varying dictionaries, we can then use them to construct what we call E6, short for Environmental and Social Index. So just to demonstrate how well or not well our approach actually works in capturing change in context, for example, just take the seed word pollution. We feed this single word into, let's say, the 10 decades preceding 1920, and the same for 1970 and 2020, and we can get different snapshots of the set of keywords that were most closely related to pollution in these different time periods. And you can easily see that throughout time, the specific issues related to pollution that we've cared about has greatly changed over time, right? Going from water pollution to air pollution, environmental pollution in general, as we established the Environmental Protection Agency in the US in 1970, and then in the recent couple of years, more related to climate change and emissions. Same for, you can see the same kind of example for inequality and discrimination. And so using this, we're going to construct, first of all, an article level share of the n-grams that are related to, that belong to these time-varying ENS dictionaries. And then each month, we're going to average this across all articles. Okay? And that gives us a very granular monthly frequency time series spanning back to 1890. And we're going to constrain the set of articles that we focus on to those related to business and the economy, so that we're capturing these kind of discussions in the context of business and the economy. And so this is what our measure looks like, right? And what you can take away immediately is that you don't only see an elevated level of public attention to these issues recently, but even in the first half of the 20th century, there's been a lot of discussion. Now we can kind of break this down into discussions about the environment or other social issues. Environment captured by this dark gray line, and social captured by the light gray line. And we can also kind of see that where the peaks align. What kind of historical events do the peaks in our index correspond to? For example, in the first half of the century, there's been a very sharp uptick in social issues, concerns about social issues around the Great Depression, another peak around the Civil Rights Movement, more peaks in the environmental index related to the Paris Agreement and so forth, and a recent social index peak related to Black Lives Matter and so forth. And so in other words, this measure seems to be capturing what it's supposed to be capturing. And what's really interesting to see is that in the second half of the 20th century, there was more concerns about social issues than the environment. And then in the later half of the century, we see a lot of discussion about environmental concerns. Now we can also kind of try to validate our measure by looking at whether our environmental component of the index tracks well with other measures people have developed to measure climate policy uncertainty specifically, which of course would be just confined to the recent period, and it does. Okay. Now that we have our measure, we can start to answer some really interesting questions. And the first question that we're going to try to shed some light on is, well, when is there a lot of discourse and concern about environmental and social issues? And we're going to try to relate that to socioeconomic stability or the lack thereof. And what we see is that, generally speaking, there's very little concern about the environment, but a lot of concern about discrimination and inequality-related issues during times of economic turbulence. For example, when you have volatile GDP growth, and that used to be true for very much of the first half of the 20th century. And likewise, during times of very high employment, and during times of very frequent economic recessions as measured by the MBER. Okay? And you can also see that the social concerns about social issues also corresponds to periods of high instability in the very fabric of society in terms of economic inequality as measured by the Piketty measure. And so these are, we think, really important findings that shed light on the macro relations of when people are concerned about these issues in a way that we really haven't thought about measuring before. And we think this is going to be important going forward, especially in light of the kinds of changes that we start to see in the way we discuss issues with practitioners and the general public and politicians. Okay? Okay, now in the remaining little time that I have, I'm just going to try to demonstrate a couple of applications as to how people might go about use this measure. One way you could use this is to use this as a revealed measure for corporate responsibility. Suppose you have a stock that tends to do well when people are concerned about environmental issues. Perhaps we can call that positive exposure to the E6 measure as a proxy for corporate responsibility. Then you can go about using that exposure to see whether high exposure stocks tend to earn better returns. That would be an indication that markets prescribe higher future returns to stocks that are more responsible. And at least in the current version of our paper, we don't find much evidence of that. Likewise, if we do it for environmental and social separately. And you can also start to look at the real effects of public concerns about environmental issues on corporate outcomes. For example, the level and efficiency of corporate investments. Right? So for example, we can estimate a panel vector autoregression and plot an impulse response function to look at when there are perturbations or shocks to the extent to which people care about these externalities. Does this stimulate or dampen corporate investment in the short run and perhaps more importantly in the long run? And what this figure shows is that at least in the short run for the immediate couple of years after there's elevated concern, corporate investment is dampened, but actually in the long run, going out 10 years out, for example, the level of investments as a fraction of assets actually increases beyond its original level. And actually, this long-term improvement is more concentrated among firms that seemingly have better investment opportunities as measured by Tobin's Q, indicating that public discourse about social and environmental issues doesn't necessarily hamper economic efficiency. In some sense, it somehow directs resources to the right places. Okay, so just to conclude, we come up with this new measure of public attention to environmental and social issues related to business and the economy. We're trying to harness information embedded in our history and sort of harnessing some of the new technological, methodological advancements that we have at our disposal. And we try to shed light on some important macroeconomic, socioeconomic points and also demonstrate some applications of how this measure might be used. Thank you very much.
So I invite Aaron Yoon. I couldn't think of a better academic expert on the topic of himself, if you look up Aaron's own work on textual analysis and so forth on greenwashing is highly commendable. So very much looking forward to your feedback.
Thank you. Thank you for having me. Thanks for having me. My name is Aaron Yoon at Kellogg. I'm an accounting academic, and I'm very happy to be discussing my two sort of finance colleagues, right? If Buhui, right? You're in finance too, right? My kids school, when we meet with parents, they ask me what I do for a living, and I tell them that I'm an accounting academic, and they're like, "Can you help me with my taxes, etc." But where I view the value add of accounting, especially when it comes to ESG, is that how can we account for ESG activities and how can we measure it, and sort of bridge the gap between managerial accounting, financial reporting, which helps investors use the information. So that's sort of where I'm coming in with this discussion. So the agenda is pretty simple. What is the issue at heart? Oh, it's right here usually. How does the paper extend our knowledge? How can it be used by investors and other important stakeholders? What are some important related questions that came up to my mind? And what are my additional suggestions / quibbles? So I wanted to start with the first paper. Buhui did a great job, so I won't sort of go into the details, but He et al., looking at greenwashing, measurement and implications. I wish, I told Buhui straight up, it was something that my co-authors and I have been working on or pushing, and he wrote it, so we gave up a couple weeks ago. So, I think it's a great paper, very interesting. What is the issue at heart is essentially greenwashing, as the paper titles, right? And we, both as academics, as well as practitioners, as well as citizens, have really experienced this big pushback towards ESG. So ESG took off. People say different things, but post-2015, after the Paris Agreement, market's been going up 15%. Investors been doing or claim to do a lot of ESG, and there's recent pushback after this greenwashing realization. So apparently there's negative parts or bad parts or the dark side of ESG, which is greenwashing, right? And I think this paper gets at the measurement of it and pushing our knowledge forward. So let me put a little bit more texture. So as Buhui nicely described, there are papers that look at investors' follow-through of ESG. So Pedro's paper looks at international UNPRI signatories, find that European asset managers tend to exhibit sort of more ESG follow-through. I have Hao Liang, who also takes part in this, the PRI, network, also has a paper looking at UNPRI hedge funds. And I look at, with my co-author Sehoon, looking at mutual funds. And, on average, there seems to be sort of little follow-through. At the firm level, the only paper that I was able to sort of think of off the top of my head was a paper by Raghunandan and Rajgopal. They look at business roundtable signatories and essentially find that there is very little follow-through among firms. So when you sign business roundtable, you have more EPA violations, issues, etc. Where this paper is coming in is that it is coming with a very simple and intuitive index on greenwashing. So you get this real certification on real greenwashing, right? So how can the paper help investment decisions? So I wanted to highlight a few tables. So the first table is predicting future accounting performance, profitability. Second table is highlighting the short-term market reaction. And essentially what the paper documents is that greenwashing predicts future accounting performance, and that market exhibits a, I would say, relatively moderate abnormal reaction. If you extend, and that was a cumulative abnormal return of 5 days, if you expand the window, you see that this actually tapers off, this effect, right? So one thing that I was curious about, which could potentially help investors think about greenwashing and its implications on asset pricing, is how long does this effect drift? And is there an opportunity for investors to potentially take advantage of by refining the signal or using the signal as is? And can this signal be refined to even predict future returns, which is of an interest to investors? So how can the signal be refined? I took this graph from Googling, and why listen to earnings conference calls, the title of the article. And essentially, earnings conference call is a value relevant signal that drives price. What I really liked about, and I advise rep risk, so I'm grateful that Buhui used the data, etc. I think there's two things that could be done to improve your signal. First, you look at essentially all rep risk data, right? But if they have this SASB materiality indicator flag, and then I have another paper that uses market reaction to each incident, and if it's greater than 1% absolute value, we use it as a material signal, kind of inferring that market understands it. So if we can refine the signal of rep risk to match it to earnings calls value relevance, potentially I think there are rooms to refine the signal for the benefit of investors. And I think also when we view greenwashing, people usually view it as a cheap talk, right? So I love the results on operating cash flow, its ability to predict future operating cash flow, but I think looking at the impact of cost of capital could also inform investors about, oh, this actually, deceives the market for some time and it takes some time to unwind, for example. I think this result verifying against future ESG ratings, so to examine whether ESG raters understand greenwashing is very compelling. I personally thought that it'll also be interesting to look at MSCI IVA rating that has materiality tilt built into the rating system. And this is more so from MSCI's Linda Lee, who's looking at the, watching over the MSCI Sustainability Institute these days. But KLD, according to her and her team and her colleagues, it doesn't vary much after 2013 because they gradually phased out of the data set. So I think it's already compelling. So maybe it doesn't hurt to just remove KLD data. Other suggestions. Sort of minor for an accounting, sort of, it's like an accounting academic type of stuff, so I will just skip for the sake of time. So really enjoyed this paper. Second paper, Houston et al. By Sehoon. This was a more difficult paper to discuss because, we talked about it yesterday when we briefly met. But issue at heart is what is the relationship between firm ESG efforts and shareholder value, to me at least. Again, this is a very important question because in order to, I think, fight the pushback, we need more robust evidence on how ESG effort is related to shareholder value. When is it related? Which ESG efforts are related, how it changes over time. And I think this changing over time is a very important angle, and I would like to spend some time. So what is the contribution of this paper? Essentially, it's both papers are measurement papers, and from an academic standpoint, that's a great way to collect citation, right? So Sehoon's paper is creating this index, E6. It's a time series index that measures public attention to ESG and how it varies over time, right? And what I really liked about this paper is that they create this E6 exposure measure, which I think Sehoon, you didn't highlight as much as I wanted you to. But it's a time series index that measures firm level exposure to E6. So how sort of the market or the broad society views on it. So again, it's a very simple measure, and it's essentially looking at the efficiency of this information being priced in and how long it takes, at least to my view. This is how I view materiality of ESG. I personally view ESG just like any other investment, like R&D and CapEx. The friction is that it's very difficult to uncover the link between ESG and shareholder value because none of it, or most of it, is not reported. So if you assume that ESG is an investment activity of the firm and you view that it should in theory be material, this is how I view it. We have firm I, industry K, sustainability information J, which is essentially each granular ESG factors, and time. And people like ESG raters, for example, use some type of materiality definition for GRI, SASB, et cetera, to capture it, and there's measurement error in this, right? So for example, AIJ represents that J, sustainability information, may just be a proxy for information identified by SASB as material. So there's gonna be some noise, right? J could be material for SASB for that particular industry overall, but not for the particular firm. D, for example, represents that materiality is very dynamic. But all of this, we've looked at from a firm's perspective and some type of classification. I think the value out of this paper is that you're bringing in role of public attention to this question, which not many people have think very deeply about from my understanding. And I think that it's potentially an improvement for people who use sort of existing ESG rating that are often at the sector level that doesn't vary across time much to highlight the value relevance. So I have a couple more thoughts. I only have 90 seconds left. I also thought that this index could really add value to sort of this whole new ESG data landscape that looks at news. So True Value Labs, Rep Risk, Ravenpack, I've all used, and I'm affiliated with 2 of them, so take my word with a grain of salt. But True Value Labs uses positive and negative ESG news and create a sentiment index at the firm level, but it's a black box, generally. It's very difficult to see how exactly sentiment is shaped by the news. Rep Risk only uses negative news. Ravenpack have mostly negative, but also have some positive, but it's only 15% of coverage, at least looking at US firms post-2010 of rep risk. So where is this paper coming in? I would say reasonable people would agree that it's validated over 130 years of data and it's very sensible. It could also be used going forward. It essentially has universal coverage because you're using stock return to infer this time-varying nature of E6 exposure. There's no black box and it's a very simple index. That's sort of how I view this. So I have minor suggestions. I have 10 seconds. I'll send it to Sehoon for the sake of time. Thank you very much for this opportunity to PRI and the conference organizers. Pedro, thank you. Very timely and important papers for academia and as well as practice. Thank you very much.
Right. We'll now turn to our practitioner discussion. Athanasia, Karananou, who will be giving us a street perspective on this. But I should highlight Athanasia's work also at PRI, so she's very broad background in this, and very privileged to have you on stage today.
Thank you. I think it's a tough act to follow. But on the other hand, I'm last, so I can not repeat some of the things that you said. I have to say these were 2 great papers to read, and my briefing was to study. So I've got study notes. I think Pedro will be happy with me. So thank you for having me. It is a pleasure to be back at the PRI, and I'm really pleased to particularly join the stream of the academic network. I think there's some leading RI research that has been produced out of the members of this academic network and, of course, of the committees. I might start very quickly with adding a bit of context. I also feel I need to defend my credentials after these presentations. Just maybe to give you some helpful context that will help with my remarks. I won't spend too much time on it, but I think just to highlight that I'm the head of stewardship at RBC and Brewin Dolphin. We're the UK wealth manager. We manage about 60 billion pounds in assets under management. And being a wealth manager, I always say it's not the same as being an asset manager. We're very close to the client, who often entrust us with generations, we work with them through different generations to preserve and grow their family wealth. We are an advice-led business, which means we spend a lot of our time trying to understand our clients' financial goals, the risk appetite, and accommodate their preferences. But for me, working in wealth for the past 2 years has really shown me that we take a very long-term perspective. Because we work with these clients for a long time, we want to make sure that we preserve the value that they have entrusted to us. And what I really like about Brewin, which is one of the reasons I joined, is that they have a dedicated central research team. We have a number of brilliant analysts that actually do the company and fund research. They incorporate ESG, and they do stewardship. So it's very integrated. So for me, coming from the PRI, that was exactly the sweet spot I wanted to be in. And what we do at Brewin, we invest money directly. So we always want to come up with the best opportunities for our clients in our recommendations. And we also recommend funds because we want to diversify risk and gain exposure to asset classes. And why does academic research matter to us quite a bit? As I said, we have a central research team, and they have spent a considerable amount of time refining the research process. And there's been many, often endless intellectual debates about different ways that you can do company analysis, for example, and some of it is based on very solid academic research. And I personally think if you have really good academic research, it's a very positive thing. It's a bit of a beacon because, you know, we are in a, I think we're in an era of misinformation and jumping to very quick conclusions. I will move on to the papers that are both covering very important topics. On the one hand, corporate responsibility and how we price it could be really, really fundamental to stock valuation. On the other hand, it's getting harder and harder to cut out the noise and really understand what is a genuine commitment from companies versus greenwashing. I'll start with greenwashing, if I may, because that's an issue that is front of mind for many companies, but also many investors as well. I think it's fair to say that we should all be thinking about it very, very hard. I think the paper covers this very highly topical issue, and you've all summarized it really well, but if I may, I will add my summary. The paper shows that greenwashing is borderline evil, if you like. So it is associated with weaker future operating performance. Firms that do more greenwashing have more future environmental incidents, increased EPA enforcement, no increase in green innovation, by the way, so doesn't really help either. And very importantly, especially for my area of work, it aims to answer why companies engage in greenwashing and give us interesting insights around agency problems that specifically relate around CEO job security, pay for performance, and risk appetite versus growth. So these are all very important issues for us. In terms of how it's relevant to investment, further to everything that has been said, I think the fact that the paper shows that greenwashing has real implications for corporate performance and an effect on executive behaviors and incentives is really important for us because these are all focus areas in our analysis. So it's another input, I would say, for our risk assessments and for us to maybe be able to predict market reaction to certain issues. Importantly, I think the paper highlights from an investor perspective the information asymmetry that we're facing as investors. We need new measures to be able to better assess the strength of commitments and links to strategy. Also, it very honestly points to limitations of third-party environmental ratings, which they have to rely on corporate disclosures. So we need, as investors, to do deep analysis often, so we make sure our investment decisions are not based on overestimation of green performance. I quote that word for word. I really like that. In terms of challenges, or where we concur with your finding and maybe pose some challenges, I think using the Paris Agreement as a natural experiment really confirmed our own thinking around the rise of greenwashing claims. So it's something you kind of know as an investor, but it's good to see that it's actually, you can actually prove it. Also, our concerns over the meaningful links or lack of meaningful links between ESG and executive pay, which I think is a big issue, and confirmed our views of which sectors are more likely to greenwash. I think using rep risk provides a great reality check, but I also have to say that I would not necessarily equate it to an objective assessment of a firm's actual environmental performance. I would argue that it's a very strong indicator, but you have to do further analysis on what is reported via rep risk, which we have a lot of respect for. But if you're making investment decisions, you can't rely only on that. You need to look a bit deeper. And therefore, things like enforcement through EPA has been really adding a lot of value, I think, to the paper. I was really intrigued by the idea that green talk is twice as likely to indicate poor future operating performance rather than incidents. But then I spent a moment and I thought about it. And you know what? If you have an incident, you probably would have a remedy for it as a company. So therefore, green talk is a much better indicator. Environmental incidents are of the past. And usually what you find is by the time you find out about it, the company is already taking some action probably, or you'd like to think they are. I think the point about the link between greenwashing and agency issues being widespread, the problems with weaker corporate governance, lack of institutional monitoring, it makes a good case for stronger stewardship from ourselves as direct investors, but also our fund managers. And we would agree that this is really crucial. I would argue that stewardship should incorporate ESNS issues, absolutely, but we cannot forget that it needs to be fundamentally rooted in good governance. And I think sometimes it's a bit more popular to talk about ENS, but we cannot forget about how important good governance is. And then I think lastly on tying executive pay to ESG is an issue that's very close to my heart, because when I was at the PRI 10 years ago or over, we started off this work, and it has had so many unintended consequences. Your findings are not surprising. What we see when we look at executive pay plans, we really question the validity of some of the metrics that companies are using. The weak links to strategy are a problem, and complete obscurity on targets and outcomes. I think the point about higher greenwashing associated with higher environmental pay, I'm not sure if there's a causality there, because what we find in our analysis is that there's so many different metrics that can be used, and they're different, and the remuneration structure is different. So you have so many variables. So I wonder if that's something that could be looked at a bit more. I think on that note, with further research ideas, welcome further work on ESG issues linked to pay, to differentiate which metrics actually lead to increased risk of greenwashing, because that's something we can incorporate in our assessments and our engagement dialogues with companies. I think we welcome the breadth of research that you've done, 4,000 issuers. We would like to see it extend beyond the US. I think that would be particularly beneficial. And then probably not very easy, not very straightforward, but if we can have similar research for social issues, I don't know what we call that, social washing, that would be extremely helpful for us. I'll move on to the next paper, and I have no respect for time, so bear with me. I will try to keep it short, but being last freed me up a little bit. 130 years of corporate responsibility. Really enjoyed reading that paper as well. I think that if I had to put it in a nutshell, the paper highlights that we as investors should not expect any positive association between corporate responsibility and stock returns. But it gets quite more nuanced than that, right? And then if you should also expect that if there are heightened ENS concerns, in the short term, you won't have efficient corporate investment. But then in the long term, both the level and number of corporate investments actually improve, which is very interesting. And I did have a bit of a laugh when I read the abstract. It wasn't funny, but it basically said, well, the market can't price this anyway, right? So I was thinking, yeah, I mean, that applies with a lot of things that we do as investors. But I will say, this is a paper that's very relevant to how we think about investment. Of course, you have the multifaceted aspects of ESG, but understanding the real consequences of public concerns over ENS, I feel like that could be a relatively missing piece of the puzzle when we do our analysis. So I think it's very interesting to test some of these ideas. I think the link between E6 and level of efficiency and level and efficiency of corporate investments, that's actually really an interesting area for an investor that does deep analysis such as ourselves. I also think that one of the less highlighted points on the paper, but I think it's really important, it gives us some insights on the potential for company action or inaction ahead of a policy response. And I think that is another building block for us, right, when we're thinking about company level analysis. Action and inaction is equally interesting. In terms of where we concur and maybe some potential challenges, I think it's extremely important to have the historical context. Often we forget that, you know, the role of business and the purpose and ENS is not something that, you know, has only happened in the last few years. And I think it's important to highlight that. But it was really interesting to see that in the last 3 decades, I think there has been, as you said, the gradual uptick across ENS&G. And you highlight climate, racial inequality, gender, and so on, as things that have come to the forefront. And there's quite a lot of discourse amongst investors and business leaders, I would say politicians as well. I think it's really hard to argue against that in this room. We also noted that you highlighted verifiable spikes, such as the Paris Agreement and the Black Lives Matter movement, which is also how we felt intuitively. And then, it's good to see this verified as well. Again, focusing on the US is very interesting because we have a lot of exposure and you have data availability, but expanding to other markets would be good because the geographical context matters in companies' responses and the political structures are very different. So I think the response by policymakers could be significantly different in other markets that maybe are not as polarized, potentially. I think one more point would be that there's, and I don't know if that's going to be slightly controversial, but there's always an underlying inference that if companies are exposed to innocent concerns and they don't act, that's a bad thing. But we would argue from an investment perspective that is not always the case. Not sure we would want our companies to respond to public concerns when the issue is not material to the company and stakeholders and there's no business case. So I think we need to also be very open with that we don't always need companies to react to public pressure. And then last, but my favorite point by far is news coverage ever objective? I'm not sure. Checking for the macroeconomic variables is actually really excellent because it really helps you ground your findings. I think I would challenge what we define news nowadays. So where is public sentiment reflected best? Is it mainstream newspapers or social media? In terms of further research ideas, please expand the research to other markets. I think it would be really, really great for us to see. I think looking at the corporate response specifically on certain issues might be quite beneficial as well versus being a bit broader because companies will have impacts, they will have dependencies, and they will react very differently to what threatens their livelihood or license to operate versus something that's more of a nice to have, potentially. I would say social media, again, is important. The way people consume news is a game changer for public sentiment. And it would be great to see you explore further that recent positive association between X and 6, environment and social and political frictions, because as you correctly identified, that's what we're feeling as well. There's rising contention over both environmental and policy issues. So I'll conclude very quickly, and I have 3 things I wanted to say. The first one is, even if you're unable to price it fully, corporate demand for corporate responsibility will be there or won't be there, and we as investors need to be very, very aware of the wider context and to test ideas, and papers such as yours really helps us do that. I would say the second kind of a takeaway is that policy making is key, and we as investors really need to understand trends and where things are heading. And then I said historical patterns are a great baseline, but I will throw in a bit of a challenge there. Today's problem, I think, could be that we are in high 6 conditions. For example, we have rising inequality, but we're also very fastly approaching tipping points for environment. So I was going to say this is a perfect storm, but it seems really bad manners now with the storm in Florida. But yeah, I do wonder what that means for us as investors. I'll just leave it at that.
Thanks so much. Right. So, Athanasia, that was really good, and Aaron, appreciate as well. I'm going to open to the floor, so there will be mics coming through. Let me just point out something. You heard the firm discourse, and then you kind of saw the public concerns in the public media. We're moving, as Athanasia mentioned, to, yet another environment where we're all embedded in social media. ESG could, we're not asking academics to do this, but going forward, ESG could be supplanted by geopolitics. It can be supplanted by AI. Now, you also hear about AI washing and so forth. So wanted to hear from, as you ask questions, please state your affiliation. And also, if you have suggestions, feel free to throw them at them and the other people in the room as a challenge for other questions to address. So please go ahead.
Thank you. Georges Hadilakos, MNG Investments. Thanks for your work on corporate responsibility and greenwashing. I would just like to ask a question, and if you don't have an answer, it could be a suggestion for further research. Voluntary target setting by companies and asset managers such as ourselves. Have you looked at what happens if we don't meet our 2030 targets? Is that entering a litigation space? Putting reputational risk aside, from your work on reputation, on the way that governance works, greenwashing is looked and the like, have you seen any links in literature and the legal frameworks that are affiliated? Thank you.
Thank you very much for the question. So, yeah, at the moment, our paper does not look at this issue that you raised. I think it's a very good question, and yeah, I understand that currently voluntary disclosure touches on a lot of litigation-related issues, right? Firms worry about if they disclose too much, actually this could leave gateways for stakeholders to sue the firm afterwards. Yeah, we haven't looked at this type of issues. I think it's very interesting. Also, this also linked to Athanasia's discussion that what caused firms to greenwash, what type of factors, right? So it would be very interesting to look at these type of factors. At the moment, we leave this entirely open. We start with constructing the measure and then look at the implications. But we didn't actually look at what drives this measure, what drives actually economy-wide and cross-sectional greenwashing. I think your question actually addressed one of those important drivers. We're gonna need to dig into it. Thank you.
Thank you.
So maybe Mayaki first, Eagle. This is for the greenwashing paper. One of the, I guess, observations, or two of the observations, was that following events like the Paris Agreement, you see kind of an increase in green talk, and then you also see, but you also see companies have an increasing controversies the more that they do, the more they engage in green talk. But I'm curious, how do you control for the idea that you could have increased attention following an event like the Paris Agreement on controversies, or the idea that more green talk brings more green attention, so that increase in controversies might just be a result of increased attention on the company because they're talking more about this. Just curious how you control for that in the paper.
Yeah, it's again a very good point. I think your question is whether we control for like investor attention, right? Because green talking arouses attention. The attention can actually lead to lawsuits, for example. Oh, yeah, sorry. So it's a possibility. Yeah, I think at the moment our regressions we didn't control for attention. But one thing that I can tell you is that we not only look at lawsuits going forward, but we actually look at the firm's actual emission data. And we find actually those greenwashing firms, actually they emit more CO2 in the future. So those are not related to really lawsuits, right? But still the emission go up, but they're actually green innovation does not actually improve. Yeah, so, but I think your suggestion is really meaningful. We should look at attention as well. Thank you.
Hi, I'm Justin Q from Bali Asset Management. Again, going to start with, I got two questions actually to Buhui on your greenwashing. How do you control the factor analysis on the performance? How do you control for market performance? Because you say that companies that greenwash has different performance attributes. So how do you control that? Is that an alpha signal, or is that just a general set of performance? And I think the 130 years of CSR piece, interested to hear about how we as investors could potentially use that signal, because I'm in very strong agreement that when there's societal pressure on certain topics, it becomes relevant, which then ties to the price sensitivity movement in the market itself. And I think I agree with you on that. But so interested to hear, how do we harness this? I know some people say that we should look at strike, protest, or NGO. That could be one of the signals, but interested to hear how we can walk out from this room is something that we can use, or if it's something you are going to build, come and talk to me. I can definitely collaborate with you on that one as well. Thank you.
Sehoon, do you want
Well, thank you very much for the question. I think it really directly is related to Aaron's discussion and his comment about what we devised as sort of a firm level exposure based on our measure. I probably didn't have enough time to kind of properly highlight it. But the idea is that, well, perhaps you can kind of measure firm level exposure to this measure and use it as a proxy for how good or poor ESG this company is, and then according to that measure, exposure measure that I've just derived from the index, you can use that to form portfolios. For example, the cumulative return chart that I was showing in the figure was basically sort of a cumulative return series for a portfolio that longs the highest firm level exposure stocks and shorts the lowest exposure stocks. So it's basically longing stocks that tend to do well when people are concerned about these issues, and shorting stocks that tend to do bad when people are concerned about these issues. And so that would be sort of like a straight away investment practice application of how one might go about using what's apparently just a time series index and sort of converting that into a firm level or stock level index. I wonder if that actually answers your question, but yeah.
So for thank you, Sehoon. So for your question, actually, when we measure stock returns, right, we also control for the factor exposure. So basically, the cumulative normal stock returns, basically you can think about it as alpha. And we also, for the operational performance regression, we control for the industry by year fixed effect. What does that mean is that we basically look at whether within the same industry, the same year, those firms actually underperform the non-greenwashing firms or not, and indeed it is. So basically, through industry by year control, basically, we are doing within the 3-year comparison. Thank you.
Please go ahead.
Can you hear me? Okay. So I'm Amar.
Next.
Yeah, I'm Amar from the University of Waterloo, and I had a question about the paper on greenwashing. So I'm just wondering what motivates your choice of focusing on conference calls. So you mentioned that, for example, that you choose conference calls as opposed to annual reports because they are less structured forum or channel through which a company can deliver disclosures or communication to its stakeholders. But for me, like when I think about disclosures related to environmental, social issues, the main disclosure channel that comes to my mind is a sustainability report, and it's also not it's not a channel with structure or format similar to an annual report. It has a lot more flexibility. So and it's in my mind this is where a company would generally disclose most about its environmental, social, and governance performance. So yeah, I'm just wondering what motivates the focus on conference calls as opposed to something like a sustainability report.
Yeah, I think that's a very good question. So the reason we focus on conference call instead of some other venues, I think your suggestion, looking at ESG reports of firms are really valid. But the issue is basically that ESG reports are still not a common form of disclosure so far. Still, a large portion of firms do not disclose any ESG reports. So if we focus on ESG report, we're going to miss a large portion of firms, right? So, but conference call, basically every firm as long as you are publicly listed, you need to conduct conference call. And conference call is a better venue than 10K in our view, because 10K is very structured. Basically, it's very little room for maneuver for managers. And conference call, there are basically 2 sections. One is managerial presentation, the other is the Q&A. And it's actually in the Q&A session where we find a lot of greenwashing. We also separately measure construct our measure using both sections, and we find most of the result coming from the interactive sections, because in this section, manager has a lot of room to maneuver to basically portray their firm's enthusiastic, positive performance and effort. And actually, that's what we find greenwashing results. Thank you.
Let's get one last question, please.
Yeah, thank you. Gabriela Krapos from APG Asset Management. I also have a question on your paper on greenwashing. I had to take the screenshot because it was very detailed. But one of the things that struck me was that you're using rep risk and then the environmental incidents as input to actually look at what companies do. One of the conclusions you drew was that green talk leads to better ratings from MSCI or Sustainalytics. And to me, the first question is, how is it possible? So did you look at the discrepancy between rep risk and then these incidents and the outcome from rating agencies that we're all using to assess what the quality of a company is? So I don't know who from MSCI or Sustainalytics is in the room, but I would be interested how they view this premise that you're making. To me, this is very interesting what you're saying. So I don't know if it's exactly what you looked at, but this is a very important input deliverable for you. And you're saying something about rating agencies that we're all using.
Yeah, very good question. Actually, I presented this paper before in an industry kind of forum, and the director of Sustainalytics is my discussant, and he doesn't really like the paper too much. Yes, you can understand basically the view there. And the reasons, of course, what we find is that both components, the talk and walk component, positively related to environmental ratings, very interestingly. Even if you walk very negatively, environmental ratings still go up. So, and this is actually kind of consistent with some recent papers, very influential papers by Berg et al. And some others, Christensen et al. They look at basically problems with the environmental ratings. Those ratings, I'm very sorry if there are some analysts in the room, but I'm just reporting what the academic studies find. What they find is that the ratings, sometimes they are not very consistent. They're influenced by firms' self-disclosure, things like that. So there may be a certain level of discretion or certain level of bias in the ratings. So that's, yeah, the results actually puzzle us as well, to be honest with you, because we thought that only the talk were gonna influence positively future ratings, but actually walk also is positively related to ratings, although it's to a lesser extent. So that's actually puzzle us as well. Thank you.
Right.
Could I jump in with a quick
Yes.
comment? I think that was my reaction as well. But I think the way rep risk works is slightly different. And that's why my comment was it's an indicator, but it's not a full-on assessment, right? So it's a flag, whereas the rating you would get from the likes of MSCI Analytics is a more complete assessment of the company, whether you agree with it or not, whether this applies or not. They're just there to do different things.
Right.
But yeah, it was a question for me as well.
Well, thanks so much. And again, this is another chance to bridge the two worlds, but the conversation should not stop now, and you should approach if you have questions and thoughts and suggestions to the folks on the panel, please feel free to engage. My last role here, if I could have the last slide, please. You see 3 QR codes here, which is you'll give us, join the academic network. It's over 20,000 members. Number 2, I cannot really read from here is, the events such as this one, but there's also webinars, there's blogs, and there's going to be a lecture series as well, which we're very proud to introduce. But just generally a call for, all of us want to learn from, myself included, from you guys on if there's good research questions, good data out there, good empirical settings, if you're, if you can actually open your doors for academics to come in and study those issues alongside you, or vice versa. This is the venue, and the conversation doesn't stop here. We're going for lunch, but there's a lot more program coming up in the afternoon and into tomorrow. So again, thank you for being here, and I look very much to touching base with all of you, and let's all thank the presenters and the discussants for